Assalamualaikum. Today we already gone through this example and most of the participant already give the correct answer, but just for quickly, most of you guys understand the basic concept of the tax liability computation. Just we'll go through the quickly because there are many things that, okay, this is one of the basic example you guys understand, but the other example we'll go through. If you guys say yes, so we can go through the other. There is a 5 example. Either we can do now and later on we start the session, or we can start the session and later on I'll share the example. The purpose of that we would be on the same page and have the better understanding. Here, the already mentioned the ALLC incorporated in UAE in the tax period ending. Okay, here the most another important factor that we have to see ALLC incorporated in UAE. Such thing we have to understand. Okay, incorporated. Where is incorporated? We have to while reading the question or whilst going through the text or scenario, any of where is incorporated. This is the most important you guys have to understand. Now this is the incorporated in UAE. So it's a resident company. There the concept is resident and non-resident. Before that, if you go through a LLC, so LLC means juridical person, is not natural person. I was expecting you guys highlight some of the, such element while asking, because most of that our participant give the appropriate answer. But these are the key area that we have to read appropriately while jumping into the solution. So here the ALLC, first of all, we have to see this is the natural person or juridical person. The second, the company is incorporated in the UAE. So this is the resident and non-resident point that we have to check. The next point, what is the tax period? So tax period here is mentioned, the ending is March 2025. So such point have the meaning and it will impact on the practical scenario. This is a simple example, but if you learn these points and apply in your practical scenario, wherever in the organization you are working or wherever the uh, you are giving the solution to the one of your client. So these are the key element you have to go through. We already understand the juridical person, natural person. We already understand the incorporated in UAE natural, sorry, the resident, non-resident. We already have this understanding. Then the tax period, accounting period is the tax period. We already go through the accounting period and tax period will be the as per the memorandum of association. Now the next part is the LLC generate the revenue. Okay. So here he mentioned that generate the revenue 8 million. So our revenue is 8 million. So we will calculate our tax liability on the taxable income, not on the revenue, not on revenue. So this point is why I'm highlighting, because this is the revenue, but what we need the taxable income, but we need the taxable income. We What will be our taxable income? Okay, guys, I think it's not getting switched appropriately. Let's continue in the one color only. Again, I'm summarizing the LLC incorporated. So now in UAE, this is the resident, the tax period, the year end. Now the revenue, we are seeing the revenue is 8 million and incurred expenses is 2 million. So expenses are the 2 million and net profit is 6 million as per the financial statement. Now financial statement, we are preparing the financial statement as per the accounting standard as per IFRS. This is the first stage that we are normally doing so far. So now then we already understand what are the key points we have to go through. And taxable income, LLC taxable income for its tax period will be the accounting net profit of the business after making taxable adjustment. So he already giving us, okay, the taxable income, how we'll calculate taxable income for each taxable period will be accounting profit and loss of the business after making adjustment of certain item specified in the corporate tax. For the purpose of this example, ALC does not need to make any tax adjustment. So here, because we already gone through in the last session couple of adjustment, but here is in there is no adjustment. The course example is a simplified. Thus, is a taxable income will be 6 million after the 6 million for the tax period. So he already gave us the taxable income. We don't have to calculate the taxable income. But as of now, our topic is to calculate the taxable income from accounting profit. From accounting profit and loss, we have to calculate the taxable income. Our journey is so far is here. But here for understanding the taxable income, we already have it. That is a 6 million. We have to apply the corporate tax rate and take the tax liability. What is the tax liability? So to calculate the tax liability, first 375 will be zero rated. It's a taxable, but first 375 is zero rated. This is not like the VAT where the up to 375 threshold for registration. Here the 375 is not the registration threshold. Here is the tax band. First 375 is a zero rated. And the balance 6 million minus 375 is a 9%. Now the next one, in order to calculate UE corporate tax, LLC will need to consider if there is any tax credit. Okay. So now the another point here that highlighted for understanding so far is not available in this example, but we're saying once we have the tax liability, so we have to check whether there is a tax credit or tax reducer that can be adjusted against the tax liability. So what are the tax reducer? What are the element or the computation item that will reduce our tax liability? So this we will go through in detail. This is the comprehensive topic. But here, just for understanding the what are the main tax reducer is UE tax liability, the foreign tax credit and the withholding tax. Foreign tax credit and withholding tax, these two are the main tax reducer. Now the foreign tax credit and withholding tax, we have how it will reduce. Because in UAE, the company is a registered company in the UAE, resident company in the UAE. They are taxable person in the UAE. I'm using the multiple terms because to understand, to explain you guys, all things are the same, but maybe different names are, we are familiar with that. So corporate tax liability will be calculated based on the taxable income. And from taxable income, we will have the tax liability. This tax liability, this is our liability. Now this tax liability, how it will be reduced? How it will be reduced? In order to calculate the corporate tax payable, now there is another difference that you guys have to understand here. The word is used payable, which means our tax liability and the tax payable may be not the payable also. There will be additional thing also. This point we have to understand. maybe our tax liability is there for the year end or the for tax period, but it may be the same and it may not be the same. Current example is shown the same, but in there is certain instance where may be different. What are the one of the scenario? If we have the tax available credit, maybe the company is doing the worldwide business and they having the tax calculation on worldwide income, and whatever the tax they paid in foreign jurisdiction. So we will take the tax paid in foreign jurisdiction. What are the supporting documents from that authority, and the foreign company where they registered, or the branch or subsidiary or whatever the form they are registered, how much they paid. If that income is taxable in the UAE, so they will refer, okay, double tax treaty agreement is there. So based on that, we will get the tax credit, foreign tax credit. Because on foreign income, the local income and the foreign income is already taxed. So they will say, okay, if you already paid 10% in the foreign country, so here the corporate tax is 9%. We will add all the income in this computation for the foreign tax operation, and we will calculate the corporate tax liability. We will calculate the corporate tax liability after adding the foreign operation, foreign income also. But later on, at the end, once we have the tax liability, later on, once we have the taxable liability, then we have to see how much we paid tax in the foreign country. So that is our foreign tax credit. So if we already paid the 10%, the same amount we will reduce from tax liability. But here the UAE authority, they will not give refund. If we paid the 10% and here is the 9%, they will say, okay, this much income is, you have the foreign tax credit, but they will not give you any refund on that. It's just a matter of computation. But another stance where you paid the 5% in the foreign jurisdiction, you paid the 5% in foreign jurisdiction, but in UAE the 9%, they will say, okay, now you have to pay the balance, the 4% in UAE. Hope this point is understood. So let's go back and the previous example. Okay, the same thing. The first, I appreciate if you guys, even you give the answer. If you quickly already shortlist the point that in previous example we did, and in this example also I'm going to highlight. If you answer in that way, because you have to make your exercise in the same fashion that is required in the taxation. Because if you make your habit, then you will uh, follow by default. Look into the scenario by default. What are the basic concept or what are the basic element that we have to see while doing the computation? Mostly the people are in the consulting. This is important for them also because each client are different. They have to understand these basic point while taking the assignment, while working on the assignment, while delivering to the client. Such assignment are such areas that will help you to generate revenue for you and give the accuracy to the client, because if you are not familiar in that way, so you may opt some assignment, and whether you are not aware the scope of the work, at the end you will stuck on that. Maybe you taken the assignment based on the local income also, only the UE income also. But once you dive into that, you found that they have the foreign worldwide income also. That is also taxable. You have to do the calculation. You have to prepare the financial statement. This will be additional task. Your allocated or counted hours now is not the same. Your mandate is not the same. So if you look into that perspective also, highlight that perspective also while defining the scope, this would be much better for you guys and avoiding the inconvenience for the both parties. Anyhow, CLLC, firstly, I'm seeing own and operate hotels, okay, in the UAE. First, the LLC give us the juridical person, UE is the resident person. Now the CLLC, the accounting income. He did not mention any other thing. He just mentioned the CLLC accounting income, the taxable profit, 8 million. So in accounting, we calculate everything as per accounting standard. Even the city law is mentioning, but again and again, he's saying, do your calculation as per the applicable accounting standard. So what is the applicable accounting standard in UE? Is the IFRS. Is the IFRS, they mention if your revenue is less than 50 million, you can opt for the IFRS SME. If your revenue is more than 50 million, then you have to go full IFRS. So there is a big difference in the SME and the full IFRS. Your computation or your working will be reduced. Now, the second is the main income drive from the operating hotel in UAE. Okay, fine. He's saying the main income drive. So now he's saying the main income means the primary content of this. Primary content of this is from the hotel operation. Now he did not mention the 100%. The second part is, however, they're saying it's also on 50% of the FLLC. A UE resident company. Again, this is the important part. Most of you guys understand this is the local dividend. Right? This is the good activity. You guys already picked. This is the local dividend. If it's a foreign dividend, then calculation will be different. Application will be different. You guys already know the local dividend. You already confirmed that point also today conversation. Now during the FLLC paid to CLC 700 in dividend. Now we said the local dividend, but here is saying the 8 million the income, which means this income have this 7 million also. So this 7 million is not taxable because this is the local dividend. So first we have CLC did not incur any expenditure in relation to the ownership of LLC. Now this 7 million, 700 is linking with the expenditure. If we have the expenses also in relation to this dividend, that also will be adjusted accordingly from our books. Hope this point will be understood, because in this example, he did not mention the expenses, but in certain cases, he may mention, because, okay, dividend income is exempt, but to buy the shares, to sell the shares, he have the, I'm giving you the example of the shares that we are doing in the stock exchange. So normally if you buy and sell the share, there is a brokerage fee, or there is a bank charges, or there is additional charges that belongs to the dividend or belongs to the income that is exempt. If our income is exempt, so can we deduct the income from our accounting profit, and we will remain the expenditure that belongs to exempt income in our accounting profit? Just quickly reply on that. If we are adjusting the exempt income, shall we adjust the expenditure associated with the exempt income from accounting profit while calculating the taxable income? Hinjal, Miss Hinjal. Miss Hinjal get the good correct answer. Khalil also give the example, sorry, correct answer. Other, they mentioned the yes, so which means they wish they're trying to say yes if the income is exempt. So whatever the expenses that already deducted will be added back. See, here the topic is this small, but I'm giving you the additional information that is throughout the learning of the corporate tax. It will be helpful to understand. Such information I'll try to add on the different area and different example. Here today our learning is one is the local dividend. Second is if the exempt income we are adjusting from the taxable income. So accordingly, the expenses belongs to the exempt income that already deducted. We have to add back. Hope this point is clear now. We'll move to the next. What is the first is the determine the taxable income. To determine the taxable income, 8 million minus 700. So taxable income is at 7.3 million. Now we can apply the city liability. So we know 375 is 0%, and the next balance amount will be 9%. Now let's see the next example I'm sharing, and please quickly work on that and share the answer.